Excuse the technical difficulties. Okay, let's try this again. Good morning, everyone. Welcome to the first market session of 2026. How are you doing today, Temi?
Doing good. New year, new Temmie.
Yeah, great to have you here. Good morning, everyone. Great to have you on here, Virginia, Mark, everyone else who has joined. If you have a minute, we would love it if you could drop your name and location in the chat. If you're a consumer, potential buyer or seller, don't necessarily have to throw your name on there if you don't want to, but would love to know where you are joining us from. If you are an agent or a lender, love to know your business area of a focus. And for those of you who are joining for the first time or watching on the replay for the first time, I am Paul Nalabondian, your local market expert. I am an attorney licensed in the District of Columbia, realtor licensed in Virginia, DC, and Maryland. On Fulcrum Residential, as is my colleague Temi, we are one of the top real estate teams in the country, and we are proudly affiliated with Keller Williams Capital Properties, where I am also proud to have served and am serving on the Agent Leadership Council for the 6th year in a row. Temi, would you like to say a little bit about yourself to the folks here?
No.
We've been doing this for a while now, so I kind of know the deal on that one, but it entertains me each time. Usually it's a hi, but don't. I know it's not putting you on the spot, but a little bit of good morning fun. All right, we are going to follow the same format we always do if you have joined us in the past. And before I jump into that, would just like to say that we love it when this is interactive. I can pull all the data in the world, even down to a very micro level, but it still won't get to the immediate granular kind of information that we all are experiencing on a day-to-day basis when we are looking at properties, submitting offers, getting under contract, having listings, whether it's multiple offers or not, kind of the terms we are agreeing to. Also, what your clients are experiencing with jobs, maybe losing jobs, how they're feeling about the economy. So please throw up your questions, engage in this. There's a tremendous amount of value that comes when you all contribute. And if you're watching this later on the replay, same thing. I keep an eye on the comments. If you have any questions, comments, things you would like to add, drop them in the comment box and I will be sure to respond. Okay, getting into the substance here, we are going to follow, like I said, the same format that we always do. We're going to start off looking at mortgage rates in the economy. We look at the economy because that's what determines where the mortgage rates will be. We'll take a look at where they are, where they might be headed. Then we are going to go into real estate specific data. We look at the most recently reported month by Bright, which is December of 2025. We will look at the entire DMV, how things are going for the immediate region. Then we'll also break it down county by county, really see what's going on in these different areas we practice in. Then we will take a look at the most recently reported weeks. Usually, I just cover the most recently reported week right now because a lot of stuff is going on. A lot of things are kind of changing in the market. There's a lot of uncertainty. I'll touch on each week so far that's been reported in January, and that's 3 of them. So we're going to take more of a look in January. We're also a little bit further along in the month than we typically are. So I think it's important to hit that. Then we're going to go into the key takeaways and go from there. So keep your questions, comments coming. Would love to see them, and we'll respond to as many as we have. Okay, where are mortgage rates at? And this is another great thing. Like, I'm going to talk about what's being reported, which is great, but it's also really valuable to hear where people's clients are locking at. So anybody who's had a client lock in the past week, it'd actually be pretty interesting. If you had a client lock maybe 3 days ago, would probably be different than if you had a client lock yesterday. And Mark Lenkowitz, our lender partner from Envoy Mortgage, if you could let us know what your clients have been locking at lately, that would also be really valuable. So this is interesting. This is actually pulled this a couple of days ago when rates had dropped down to right about 6. They have since popped up a little bit around 6.2. But one thing I wanted to mention, 6.12. Yeah, that's a nice rate. Tom, when was that? I'd be curious because, like I said, it's rates. When the news was announced, we'll talk about this. 125.25. Oh, bought down the rate. Okay, Christina's saying 5 out of 7 bought down the rate. All right, so those rates are consistent with what we're seeing published. But like I mentioned, earlier in the week, rates dropped down to 6, and there was that was at least partially to do with the administration announcing that I think Fannie Mae was going to buy $200 billion in mortgage-backed securities. And if and when that happens, anytime you have, usually it's the Federal Reserve when they were doing quantitative easing, whenever you have like big dog on the block purchasing large swaths of these mortgage-backed securities, then that means basically if there's more demand for these securities, you don't have to offer as high a rate of a return, and that can bring down mortgage rates. So we'll see if there's any kind of lasting impact. And that obviously there hasn't been immediately because rates have come back up. But I want to take a quick look at this because this is important and this will inform some things I'm going to say about the market and what we've been seeing in December, January so far. I'm going to go back just a little bit. And this shows mortgage rates from basically 2021 when we originally had rates increase. And I want you to look at this bar here, and you can see that recently, in the past 4 months, we have been in this band right around 6 to 6.2, 6.3. And the reason why this is important for those of us in the business, or if you're thinking about buying or selling, is this is the first time really since rates increased originally in this latest cycle in September of 2022. This is the first time that we have had rates in this band around 6 for more than a month. If you look back to these little blips, this is the 6 bar here at the top, near the top. It popped down there a couple of times. We got to these levels briefly in September 2024, got to them briefly in September 2023, but each time it was within a month. They would drop down, they would sit there for 2 to 4 weeks, and then they would pop back up. So here we have been in this lower band now for 4 months, and that should be having an impact in the real estate market. And the impact is a little bit tempered. We'll touch on that when we get to real estate specific data. All right, so these are for the various products. When I originally did my first draft of this deck on Monday, I was talking about how everything was down 20 to 30 bips. Then they pop back up. So rates are still lower overall for the 30-year than when we met last month, but a lot closer than that. Like I said, a few days ago, they were down 30 bips. Now they're about down 9 bips from where they were last month. 15 years, about even. Jumbo, pretty much even, down 4 bips from last month. FHA and VA, essentially the same. Okay, how are people feeling about the economy? And if you want to chime in the comments, how you are feeling, how your clients are feeling, you can do that now. If you join us each month, you can take a coffee break, bathroom break, or just zone out for a little bit. I'm going to touch on why I focus on the economy. But before I do that, Temi, I'm a little disappointed. Usually, I rely on you to remind me to cover my coffee of the day.
I unmuted myself just to do that.
Yeah, so much. So this is a little swirl there. This is actually very delicious. So this is a Colombian Papayo from Luminous. They are an incredible roaster out in Las Vegas, Nevada. Papayo is a relatively unusual variety. This is only the second time I've ever had this, but it's absolutely delicious. If you enjoy coffee and you were ever out at a cafe or see a bag of Papayo beans, I highly recommend getting them because they're uniformly excellent. They brew easier than most. Even if you don't do a great job on the brew, you should get individual flavors. And I think Thai Boils is offering to become the official coffee sponsor of the monthly market session. Ty, for your generous monthly gift, we will bring you some beans. I'll brew you a special cup. We can work on the details a little bit later. Now back to our regularly scheduled program.
I'm not
Okay,
seeing any
super.
comments about the market, but I will say that I have been talking to quite a few agents since the beginning of the year, and we are seeing like a big rush of new buyers and sellers in the market in January. So it's been a much more pleasant year, like start of the year, as far as like real estate
Mhm,
goes. More people are looking to buy, more people are looking to sell, and it could be because of the stability that we've had with the interest rates.
mhm. Yeah, and we're going to dig into that in more detail, specifically when we talk about the January data and why that is important. Because I had been expecting that a little earlier and it didn't come. Okay, super quick. Like I said, if you've joined us every month, same thing. But for those of you who are new or watching this video for the first time, it's for those of us not in the industry who don't dig really deep into this. A lot of people don't understand why mortgage rates are where they at, and they think it's set because of the federal funds rate and other things. And it really is the overall economy impacts mortgage rates. And the reason for that is most mortgages are repackaged into mortgage-backed securities. This is a debt security, a debt instrument. It competes on the bond market for other debt instruments and US Treasuries. And there are a lot of smart investors out there. So this has to be a competitively priced product, offer a competitive yield in order to be able to sell these securities. And so when more people are buying bonds, then you can offer a lower rate of return on these mortgages and still be competitive, still sell them. So essentially, the more money that is going into bonds, the lower mortgage rates can be. And what determines that? Well, typically when the economy is doing more poorly, when things are up in the air, more money goes into the bond market because it's considered a safe haven for reasons I won't go into right now. That isn't happening as much, particularly with the US Treasury, but it still overall tends to be the case. And what determines where the bond market is at? Well, it's really the economy. And that's why we dig into all of this stuff in the economy is employment, inflation, retail sales, manufacturing output, industrial production. Then you also have the Federal Reserve is a big player in here. And the Federal Reserve both influences the economy and is influenced by the economy. And their levers are the federal funds rate, quantitative easing, quantitative tightening. Quantitative easing is when they're pumping money into the economy. QT is when they're pulling money out of it. And so Federal Reserve policy impacts the bond market. And then more recently, you also have you also have tariffs and trade policy, which normally don't have as much of an impact. Here, they're having an outsized impact just because tariffs have been so much higher than they really have ever been in quite a long time. And then proposed tariffs even more so. And so that's added a lot of volatility. And as Mark mentioned, yeah, right now there's even more uncertainty happening in the world, in the economy. And so you have some people who are thinking bonds are a better deal. So anyway, so depending on where the economy is and what's happening with all of those levers, if more people are interested in bonds, more money is flowing into the bond market, then mortgage rates will be a little lower. And that goes back to what I said about Fannie Mae announcing they were going to purchase $200 billion. So if you have big dog on the block flowing money into that, that's why the market reacted to that. You had rates drop for a little bit. Okay, now we are moving on. And so the first thing we're going to talk about is, when people talk about the economy, what's a great summary of that? And GDP is that gross domestic product. So the advance estimate of Q3 was released December 23, and it came in hot. The advanced estimate for Q3 came in at 4.3. And if that holds, it'll be the greatest quarterly growth in 2 years. And in the past 4 years, we have only had one quarter with GDP growth above 4%. So that is a really hot economy for that past quarter. Now, the Atlanta GDP Now model is estimating Q4 GDP even hotter at 5.4%. And it's really like I'm just losing my mind here over these GDP numbers, GDP projections, and then what is happening and the various components of the economy, because they're just not adding up in a way they did in the past. And I'll talk about why. But want to note, so I would expect the actual Q4 GDP to come in lower than this. The Atlanta GDP model always comes in higher than other blue chip models. You can see here in the band that their GDP estimate, it went from 3 up above 5 just recently, and the other blue chip estimates have not gone up. We have the New York Fed has a forecast they just released a week or two ago for Q4, and it's basically half of this number. So the New York Fed is estimating a GDP at 2.7, which is still a strong economy pushing forward. That's a great number. Most people would say if we have 2.5, 2.7 GDP growth every quarter indefinitely, would you be good with that? Most people would. That's a very nice economy, just not quite as hot. So like I said, these numbers are really high. I mean, GDP's in the 4 and the 5. This means a hot, vibrant economy where everything should be great. And that's just not exactly the case. And so I want to touch on specifically, there are a variety of well-respected surveys talk about how people are feeling. One of them is a Conference Board's Consumer Confidence Index. So that dropped again in December, fifth straight month of declining consumer confidence. So here we have these hot GDP numbers, but you have people, more and more people, worried about the economy, worried about what's happening in the economy. And then you also have CEOs. And I thought this was interesting. So the Conference Board also surveys CEOs. And the number one concern of CEOs globally for 2026 is an economic downturn or recession. And why is that relevant? Well, CEOs are some of the most informed people on the planet of what's going on in the economy, what's going on in industry. So anytime you hear CEOs of major corporations talking, if they're being honest, it's worth listening to. A lot of times they'll, in public comments, they'll simply be saying what benefits their company and their share price. But in these surveys, that's important to hear. And also interesting to note that the number one concern of US CEOs is economic uncertainty. Wonder why that might be. Anything going on in the United States or related to the US government adding to economic uncertainty? Okay. Now, I've been talking about this for a bit, but it's just important to touch on as well because we're seeing these increasingly hot GDP numbers. So why is it that we're having these initial reports of GDP for prior quarters coming in really high? We're having projections of really high GDP, but then when we look at the economic indicators, which we're about to jump into, they're not necessarily reflecting a really hot economy. And I just want to touch on briefly why that is. So the economy is very uneven right now. You have high-tech sectors and very large states that are humming along quite well, and those are masking serious problems and economic, basically slowing economies in smaller states, smaller areas, and other sectors. I noted a couple of weeks ago, the chief economist of Moody's said that he believes already you have 22 states and the District of Columbia already in a recession. And two of those 22 states were Virginia and Maryland. So according to the chief economist of Moody's, our area is already in a recession. We'll talk about DC specific data in just a minute. And then there's also massive AI buildup, just so much money pouring into AI infrastructure that is propping up the economy as a whole. And I'll just give you a little bit of numbers. I talked about a couple of these last month, but Bank of America estimates that AI investment added up to 1.3 percentage points of GDP in Q2. I mean, that's just mind-boggling. Anything that can move GDP by more than 1% in a quarter. Barclays also estimates that it accounted for half of all GDP growth in the first half of 2025. And then NVIDIA CEO Jensen Huang said just yesterday at Davos that AI is causing the largest infrastructure build out in history. And that's a little bit troubling because whenever you have one thing that is driving a huge portion of the economy, if there gets to be fatigue, if we're not seeing advancements at the level expected, then that could cause some problems with continued investment. But I want to note, and I don't want to get too far into the weeds now, but you had like similar things in the past with fiber optic build out and money poured into industries where it was a little premature or a little bit early. Then you had all of this infrastructure built up, which wasn't necessarily being used. And then you had a slowdown in investment while everything caught up. So just for what it's worth, in AI, you won't necessarily have that because technology is moving so fast that a lot of the infrastructure will be outdated and a lot of money will need to be continually pouring into this to kind of maintain that cutting edge. And then last thing, why there might be a disconnect in how some of us are feeling, how a lot of these metrics are coming in at compared to the overall GDP is that there really is a disconnect, a difference between the haves and the have-nots. The affluents are doing really well. Roughly 2/3 of the GDP is consumer spending, and then the top 10% of households account for 50% of consumer spending. And so if those at the top are doing really well, they can also prop up the economy. Then you have AI coming in as well here because there have been massive equity gains in NVIDIA and a lot of these other tech companies in AI. And so for people who own stock in that, they have seen the value of those portfolios skyrocket, having huge equity gains. And that, according to most market experts, has also been fueling an increase in consumer spending because those people have a lot more disposable cash. Okay, now, how are we looking here in the DMV? Yeah, Mark talks about an AI bubble, and that's the fear. That's the fear that if there was a dot-com bubble end of 99 into 2000. And if there's an AI bubble, it's a little bit concerning because if you have an overall economy that's being propped up by one thing and that one thing experiences a dip, we could all be in for some trouble. And so that's why I think the economy could turn relatively quickly. The jobs market is also a little bit precarious right now. I saw some analysis recently that said like overall valuation of S&P 500 companies relative to like median income or GDP. Somehow it's tied to like earnings and overall level of the economy. The overall valuation compared to like earnings, income or GDP is at like the second highest level of all time next to the dot-com bubble. And that's all well and good when things are going right. But if things start to go wrong, money could pour out of that in a hurry. And you could see some serious movement in the stock market. And then also with companies and jobs. We'll talk about that in just a minute. So at the time, you can see in here, I just want to touch on local economy. Most of us are in this area. At the time the current administration took office, the local and national unemployment levels were right around the same. And you can see that that's changed pretty dramatically since. The DMV employment rate is about 1% higher than the national rate, and DC is 1% higher than the overall DMV. And that's true. So DC almost always, at least all the data I've seen, DC has a higher unemployment rate than the rest of the country, and that predates the administration. But that level has increased since you have had all of these federal government layoffs. And then kind of want to look at, we can dig into some of this data just a little more specifically. So DC proper, the unemployment rate was 6.5% as of November. If you look at Ward 7 and 8, it's even worse. Right now, Ward 7 and 8, or at least as of the most recent data I've seen, the unemployment rate is above 11% in Ward 7 and 8. And so just talk about kind of people at the top end of the income scale and a little bit lower. This is just kind of part of that in action. You have an unemployment rate that is basically 3 times the national average. Total jobs in DC decreased by more than 4% over the prior year. Then if you look at the DC Maryland kind of group, unemployment rate was 6.1 as of November. I don't do a DC MDVA rate because BLS doesn't report it like that. Once you include Virginia, they also bring in West Virginia and includes all of Virginia. But Northern Virginia tends to have a relatively low unemployment rate. But it's interesting to see that unemployment rose 42% in Northern Virginia in the past year. So still relatively low rate compared to the rest of the region and the country. But the number of unemployed persons increased by 42% over the past year. And then if you look at, we've been talking about federal government layoffs for a little bit, but if you want to see some actual numbers connected to that, the Washington Economy Watch, which was analyzing some BLS data, said that the DMV area has the smallest number, the fewest federal employees since 2001. And the BLS estimates that the area lost about 53,000 federal jobs. And now I want to go back. I'm always like I kind of love it when I find out that I'm wrong, because it just it just shows me that I'm learning new things and always trying to seek like knowledge and the truth and get the most accurate data to convey to you all. And so I'll admit, a few months back, I made a joke about Frederick, Maryland, and how the economy was doing, or how the real estate market was doing there. And I said, what do all the federal government employees live in Frederick? And like what I was saying is valid, because like the number of federal government employees there couldn't be responsible for everything that was happening in the market. But I was a little surprised to find out that that actually Frederick and Montgomery County did have the largest declines in federal government employees in the area at 18%. Federal employment declined overall around 14%, but 18% in Montgomery County and Frederick. And then federal government adjacent, it's not just the federal government. There are a lot of companies that have contracts with the federal government and depend on the federal government for the revenue. And it's also interesting to note that tech jobs in the DMV declined by about 10% from the end of 2024 to the end of 2025. Okay, consumer price index. I'm going to talk about in a moment. Like, I don't even know if I believe these numbers anymore. like honestly, it just seems bogus to me. I feel like we have somebody just writing a Sharpie number on a board and then that gets released. But anyway, I'll still talk about what's reported. As we discussed last month, the October data wasn't released, will never be released. There's no October data because the federal government shut down. November data was released December 18th. And so the 1 month data here for November basically reflects the 2 month change from September to November. And then the December data was released last week, January 13th, and the 1 month increase came up at 0.3. Then we have the 12 month change that came in for November and December at 2.7, which is not the level of inflation that the Fed would like to see. That's not ideal, much better than it has been. But want to add, we're still not seeing the full impact on prices from the tariffs. Companies have been eating a lot of these price increases. And so the effect on the overall economy and overall prices is a little bit tempered, but we are still seeing some severe pricing pressure in some segments. Food overall went up by 0.7% on the month. So that's the largest month-over-month increase since October of 2022. And that's both food and groceries, grocery stores, and out at restaurants. Gas and used car prices, those declined. Otherwise, this overall number would be even higher. Okay, now, how accurate is this data? I've been touching on this for months. So this is when you see the deck, if you're not familiar with this, or you can read in the background or pause on the YouTube replay while I'm going over this. But essentially, in order to come up with these CPI numbers, you have price checkers, actual people going and checking on prices, and they look for specific things in specific areas. If they can't find the specific thing in the specific area, then they will impute the price. And that's either they'll take that same specific thing from another area and then adjust it for what the price difference should be in the region, either higher or lower, depending on the cost of living, or they'll find something kind of close in the same area and then adjust that price. That's called different cell imputation. It's basically educated guesses. Why do I mention this? Well, that is because this level of different cell imputation, up until recently, it was always 10% or lower. So 90% of the information that goes into the CPI goes into inflation numbers was based upon actual prices of actual items in stores. Whereas now, since the spring, really, that has increased. This number reached what I think was an all-time high in September at 40%. No data for October. We talked about, October has gone fishing permanently, but 34% were guesses in November, and then we're back up to 40% for December. So like I said, when I see these numbers, why do I think, well, does it even matter anymore? Like, what is this stuff telling us? Well, basically, half of the information that goes into this is just guesses. So how accurate can it be? And with everything that's going on now with federal government pressure on influencing these numbers come from the Bureau of Labor Statistics. The head of the Bureau of Labor Statistics was fired and replaced with maybe someone a little more compliant with administration demands. So just take all of these with a serious grain of salt. Monthly jobs added. So this is another reason why it's like you look at GDP, it's not reflecting kind of what's going on as a whole. The jobs market is softening tremendously. So unemployment rate had gone up to 4.6. That's the highest it had been in quite some time. Dropped back down to 4.4. But it's not a meaningful change. We're still seeing a big softening of the jobs market. And if you want to understand that in a picture, I'll go back to this chart. Excuse me. Just look at where we've been at for the last 6 months. Excuse me. And you can see that just the number of jobs added has dropped tremendously. And to put that just into a little bit of context. So outside of the two most recent recessions, excuse me, outside of the two most recent recessions, 2025 saw the lowest average monthly job growth since 2023. And so to put that in greater context, in 2024, the entire year, we added 2 million jobs. In 2025, we added 584,000 jobs. And there are even more factors coming into play here showing weakening. So average hours for hourly employees was declining at the end of the year. Temp service jobs lost jobs almost every month this past year. And so there are all of these signs that employers they call it low hire, low fire. We're not seeing a lot of layoffs. Employers are reluctant to have these mass layoffs. They're reluctant to fire people, but they're just not hiring anyone. And so you can see like they're already not hiring people, not wanting to commit to additional expenses. And then where else can they trim the fat? And that's where if they have hourly employees, they're working less. And if you normally rely on the temp market, you'll kind of bring that down a little bit. Then we also have, so there are 400,000 people stuck in long-term unemployment. Long-term unemployment is 27 weeks and longer, more than 400,000 above the same time a year ago. Median unemployment time is at its highest level since 2021. There are a million more people working part-time who would rather be working full-time. And then just going into where these kind of job categories have been: healthcare, utilities, leisure and hospitality, financial activities, and construction jobs added jobs. Every other sector lost jobs. And when you think about healthcare, well, I mean, healthcare, that's one of those, I talked about defensive sectors in the industry. Healthcare is going to do fine regardless of how the economy is doing, because people get sick, they need healthcare. And then utilities are pretty much always going to do fine as well. Then leisure and hospitality, that goes to what I was saying about the more affluent. They're still pumping money into, still going on vacations, still traveling, going to resorts. And then financial activities, construction jobs talked about. So Mark had mentioned in the comment, do I think the job market is the biggest risk to the overall economy right now? I would say no, only because I think we could see a pretty dramatic shift in the job market very quickly, but that would be preceded by some underlying change in the economy or economic forecast. And that could be related to like AI bubble, stock valuations. So I think that there will be some crack that will cause overall concern, and then we could easily see the bottom fall out of the job market. As far as the impact, then I do think that the job market will have, so whatever this precursor is, like that will start it. It's almost like this precursor will be someone taking a wrong step on the side of a mountain, and then this avalanche starts, and the job market, the declining jobs, rising unemployment will kind of be part of that avalanche. And I see there being a decent chance of that happening sometime soon. But it's tough to say. I mean, we really are in a little bit of unprecedented times, at least in our lifetimes, with all of this money going into AI. And so just want to touch on then in Maggie's comments about, given that the guesses are at 40% for December, how much confidence should we have in CPI as a signal for rate direction? I mean, it's still like there are only so many metrics to measure inflation, and that's a big one that the Federal Reserve relies on. One other in particular, not going to go into a huge amount of detail, but it's still relevant. If we saw these CPI numbers, if we saw the number come in at 5 or something like that, that would definitely cause some reaction by the Federal Reserve. But so it's still important. It's just like, they are also in the same boat where they're looking at these numbers and saying, okay, that how reliable are they? But they're looking at a lot more factors than we're seeing here. Okay, already talked about unemployment rate. So what's going on with the Federal Reserve? And normally I talk about the upcoming meeting, whether there will be a rate change. Here, that's almost irrelevant. So the market, I'll be shocked if anything happens with rates. They're going to meet next week, January 27th, 28th. I'll be shocked if anything happens with rates. The whole market expects rates will just remain steady. And there's really no point in talking about any of that. What is more interesting and more important to talk about is Trump v. Cook, which had oral argument at the Supreme Court yesterday, and then also the criminal investigation of Chairman Powell. And the reason I mention that is I've been talking about like market volatility for a while. And whether the Fed will cut rates in the future, that is the same thing that I always mention. It's like there are two things they're looking at right now. They're looking at inflation and they're looking at jobs. If the jobs market seems to be more of a problem than inflation, they'll bring down the federal funds rate. If inflation seems to be more of a problem than the jobs market, then they'll keep things steady. Or if it really gets out of control, they could potentially raise rates again, even though no one expects that. So that's the calculus there. So just watch those two things and you'll be able to know what's going on. But more impactful and more important is, like I said, so this Trump v. Cook, if you're not familiar with it, and I want to get onto real estate data super quick, but this stuff is like just, I mean, this could change our whole system in a bad way. So Trump v. Cook, the current administration attempted to fire Fed Governor Lisa Cook for cause. And the for cause kind of seemed like a made-up reason. And so this is going in litigation, heard oral argument at the Supreme Court yesterday. And essentially, if the courts allow this bogus for cause, that means that the executive could fire Federal Reserve governors at will, replace them with people who are more willing to follow their desires, and that would remove all independence from the Federal Reserve. And the independence of the Federal Reserve is super important. Now, just from hearing comments that the justices said at the oral argument yesterday, it looks like that is not going to proceed. All the justices had serious problems with this. Justice Kavanaugh in particular. So Justice Kavanaugh and Justice Coney Barrett, they tend to be on the more conservative side in the court. They tend to be in the conservative majority of these decisions a lot of the time. Justice Kavanaugh said, and I'm quoting here, that allowing the administration's action here would weaken, if not shatter, the independence of the Federal Reserve. And like I said, Justice Coney Barrett also sharply questioned this. So that will be remanded for a lower court. They will not allow the administration to remove federal Governor Cook, in my opinion. Now, the other thing going on is the criminal investigation of Chairman Powell that looks clearly designed to intimidate him and following the administration's wishes. He responded with a very forceful video showing that he is not going to take this line down. And then once he did that, actually, a lot of other prominent Republicans came in and said, whoa, like, I'm not going to allow for any replacement of the Federal Reserve Chair until this has been resolved. And the reason they said that is because it rattled the markets. Why did it rattle the markets? And I swear we're going to be getting onto real estate data very soon. An independent Federal Reserve is essential. It is absolutely essential to the functioning of our economy. And I talked before about how reliable government data is super important. And it's essentially because we have reliable economic data coming in, and because we have an independent Federal Reserve, that is why our markets are so efficient. That is why the dollar is the currency of the world. That is why we are the safe haven for investment throughout the world. It's because they can depend on our economy. If we lost an independent Federal Reserve, it would, without a doubt, it will weaken the dollar. It will change where investment is flowing, and that's already happening. It'll lead to higher inflation and borrowing costs. It'll increase market volatility. So, like, in short, the grave impact of this cannot be overstated. If the current administration, if Trump is able to gain control of the Federal Reserve, it will be unmitigated disaster. I don't think the courts will allow that to happen, but just something to keep an eye on. Okay, 10-year Treasury was at 4.3 when I checked yesterday. Take a quick peek. And so that was up from 4.185, 4.268. So it's come down a little bit since then. Okay, retail sales. Retail sales were up 0.6% in November from the previous month, up 4.2 from a year ago. Those were both below economists' expectations. December numbers haven't been released yet. These rebounded a little bit from sales being flat in September and October. Like I said, most market experts believe that equity gains from these AI valuations, AI stocks, are allowing a lot more money to flow into consumer spending. Industrial production and manufacturing. So October and November data were released in late December after we last met. December data was released last week. These numbers generally beat market expectations, but economists are pretty much dismissing these gains in the manufacturing and industrial segment for the final 2 months of 2025. They don't think it's sustainable. They think it was built on people front loading U.S. made goods, both by domestic and foreign manufacturers, in anticipation of higher prices related to tariffs. And we saw that kind of trickle into the economy earlier in 2025 as well. Okay, so now let's find out what's happening in the DMV real estate market. And please just keep pouring the comments in. Let us know what you're seeing with your clients. Love to hear about listings selling quickly, multiple offers, sitting for a while, whether your buyers are able to get under contract without competing, whether you're seeing a lot of options. Inventory is pretty low, as we'll talk about. So we'll just cap off. We'll go up to the 30,000 foot view. No shocker where we ended up. We're 49,408 units closed for 2025. That's almost identical to what we hit the prior 2 years. So 2024 was 49,942. 2023 was 48,950. And so for those of us who've been in the business, it's the overall volume of business has been pretty steady for 3 years, but it's still, prior to these 3 years, those are the lowest transactions, lowest units sold since 2012 or 2013. Now we're popping in. One thing, though, that has also staying the same is price appreciation. We are now here at 31 straight months of median sales price appreciation year over year in the DMV. Median sales price is at 620. Mark adds that he's seen a big uptick. Yeah, thank you for adding that, Mark. And we're going to touch on that when we get into the weekly data as well. We're generally seeing some higher buyer demand, and loan applications is one of the best things. It's like if somebody's jumping back in before they even get up under contract, before they go see showings, a lot of times they're going to reach out to the lender and get that pre-approval in there. So thank you for sharing that, Mark. Okay, so two things that have been pretty consistent. Like I said, median sales price appreciation for the area, 31 straight months that's been happening. And then also, as we've been seeing for a while, median days on market has been up. 27 days on market, that was up more than a week from the prior December. And so this goes back to, if you are a buyer out there, or those of us of agents, those of us who are agents have buyers who are kind of like, let me wait for inventory to increase. Let me wait for mortgage rates to go down. Well, if they've been waiting for 2.5 years, all that's been happening is prices have continued to rise. Not uniformly. There are areas where we're seeing some depreciation or stagnation, but it's just overall, they're just going to end up paying more for their property, and you can always refinance later. Okay, going into closed sales. Closed sales were down almost 2%. That's not a shocker because pendings were down last month. New pendings were up 1%. Both of these are pretty close to where we were last year and kind of consistent with what we had seen for much of 2025. You had pendings and closed sales really tracking this kind of band that they had been in the prior year. And this band was also at the low end of where we had been out for the past 5 years. But, and this is why this isn't meaning like, oh, the market's just kind of steady. That's not the case. What these numbers tell me is that buyer demand was softening in December because, all things being equal, we should have seen a bump in pendings and buyer demand. So last December, mortgage rates were in the 6.7 to 7% range throughout December. This December, we've been running, like I said, in the lowest, we've been in this band of the lowest level where we've been at for the last 3 years. When that's happened previously, since the rates originally increased a few years back, anytime you would have a drop like that in mortgage rates, you would see an increase in pendings pretty quickly. We didn't see that in December. And so what does that mean? It can either be a lingering hangover from the government shutdown or worry about economic stability. It could be just a random blip, or it could be signs of a greater market change. And so I think it's more lingering hangover from government shutdown and kind of economic uncertainty than an underlying market shift. The market is changing, but we are seeing signs, like Marcus mentioned, Temi has mentioned, and we'll talk about in the data, of buyer demand increasing, and expectations are that there should be more transactions in 2026 than there were in 2025. Okay, going into new listings. So this is pretty much even from last December, which is actually more news than the closed sales and pendings, because November, as we talked about, had the lowest level of new listings of any November for the last 10 years. And that's just because I can't, like, the data I have access to, I can't go back farther than 10 years. So November had the lowest listings of any November that I could get data to, and the fourth lowest level of new listings of any month in the past decade. And so, like, what did that mean? Did that mean something greater? Well, it doesn't appear so, because now we're kind of back on track to the pace we had been. Active listings, again, this is pretty consistent with where we have been at. Same old, 23rd straight month of year-over-year increases in active listings DMV wide. So the last time we didn't have more inventory in a given month than we did in the same month in the prior year was January 2024. And so this stuff, just want to note, this is like inventory increasing. Yeah, federal government layoffs are probably influencing this somewhat, but this has been going on well before the current administration. So this was already a market shift that had been happening that predates the current administration. But just want to note, even though we are seeing higher inventory, we are still below 2019 levels. These levels for December ran the numbers, what was it? 83% of the inventory level of December 2019. I consider 2019 to be the last normal year, because then we had the pandemic, then we had low rates, supercharged things. And so I look to 2019, we're still below 2019 levels. All right, that's just more of the specifics when you get the deck, if you want to take a look. Now we are going to take a closer look at county data. So median sales price, we talked about median sales price DMV wide. We saw overall price appreciation. And unlike past months, we saw price appreciation through most of the individual areas here. Arlington is down. Arlington's always a bit weird. There's just such a dramatic range of like single family detached homes in the 2.5 million to studio condos, for 250,000. And so you see these wild swings in median sales price in Arlington. And a lot of it is just where the sales are in an individual range. I looked under the hood and saw that there was a big jump in homes that sold in December in the $600,000 range, more than the prior year. And so it really is like, I almost always just write off Arlington median sales price data because it's not based upon the actual values of homes rising or falling. One thing to note, though, interestingly enough, that the condo prices in Arlington jumped by almost 14%. Usually it's the opposite. Usually you have fee simple pushing prices up, condos maybe bringing them down or holding them steady. Not in Arlington. Prices jumped by 14%. Most surprising thing, super quick, Timmy, if you looked at this, what would you find is the most shocking thing about this chart? Timmy, did we lose you?
Nope. Can you hear me?
Yeah.
Can you hear me? Oh. Most shocking thing
Yes.
about this chart. I think Frederick County.
Timmy. Okay. Well, I don't want to answer for you because whatever you find is the most shocking thing in this chart is the answer, because that is what I asked. So what I find as the most shocking thing from this chart is DC. Prices up in the District of Columbia year over year by 14.7%. I mean, prices, like if you looked at every month for the past 3 years, DC usually was at the tail end of where appreciation was. And no surprise, it was led by fee simple. Detached homes and row homes were both up big. Condo prices were even year over year. That's surprising, though, because all the other metrics are DC market's a little soft, but we did see median sales price shoot up. And I think that's also due to property style distribution. But okay, closed sales. November closed sales were down everywhere except Loudoun, where they were up big 8.7%. We saw a rebound kind of this in December, where it was a little bit of a mixed bag. Closed sales were up big in Northern Virginia, 15% in Alexandria, 27% in Arlington. They were close to even in Fairfax and Frederick. And so that's another thing. It's like you have closed sales increasing by 27% in Arlington, but median sales price decreasing. So whenever you see like that much more activity, just seeing that should let you know that it's probably not a real decline in prices. And then closed sales were down big in Prince George's County and DC, which we've been seen for a bit. They generally are the two areas with the softest buyer demand in the area. So new pendings for December, which will tell us where closings are going to be at for January. So new pendings, a little more all over the place, kind of down in Northern Virginia, which is surprising. So I think that's a serious blip. Like the fact that we're going to see that rebounded. But talk about what's the most shocking thing about this chart. That's what surprised me, is that we saw a drop 2% in Alexandria, a little over 10% in Arlington. Pendings were up around 2% in Fairfax and Frederick, up big in Montgomery County, 7.5%, and then down pretty big in Loudoun by 6%. So down by just a little bit, almost even in Prince George's County and DC. Part of this is, so if you just look at this and think, oh, DC and Prince George's County are hanging in there, they're almost even where they were last year. That is more reflective of how depressed the market already was last year than the fact that they're humming along. So there's a lot of base effects happening now when you're looking at year over year numbers for DC and Prince George's County, because their markets have been depressed for a little while now. So last year at this time, you had more vibrant markets than some of the other areas. And so you're seeing more dramatic year over year changes. And that wasn't the case in DC and Prince George's County. So median days on market. There are a few things that have been consistent across all areas. Inventory and days on market is one of them. And we now have, like I said, 18 straight months of year-over-year increases in median days on market. The last time we didn't have a DMV-wide increase in median days on market was June of 2024. And as has been the case for quite a while, DC is leading the charge here. So median days on market in DC, 43 days. The shocker here, though, is like there was some weird stuff going on in Northern Virginia in December. Alexandria was up to 41 days. That's the highest days on market in Alexandria since February of 2016. That's surprising. And then Arlington had the second highest days on market here in the area, 33. Oftentimes, they're some of the quickest to go under contract. So I think this is just an exaggerated kind of seasonal blip. I looked at what is going on right now for properties under contract in Northern Virginia. So median days on market in Alexandria for current properties under contract is 25, and for pendings is 12. So already in Alexandria, those numbers have shrunk down. I think that was kind of a seasonal blip. Arlington is still a little higher, though. Days on market for active under contract is 40, and median days on market for pendings is 24. By comparison, though, the current days on market in DC right now for all properties active under contract in DC, median days on market is 84. That's wow. I mean, that's double this number. For pending, it's 54, which is still a noticeable amount. So that's a good question, Christina, because sometimes when I try to get a little more information from this data, I have a bit of a trouble finding answers. And so my assumption is like what I just told you, I used median days on market, not median cumulative days on market. When I'm looking for me at stuff, I look at CDOM, cumulative days on market, because that accounts for if a property went on, they pulled it off, tried to do something a little shady and created a new listing, then put it right back on. And so that will show a new days on market, but the cumulative will be reflective of the total. So I view cumulative days on market to me the more valid number, but I do believe this data just pulls off of days on market. And my understanding is that generally when you have a listing, if it gets pulled off and put back on the market within 90 days by the same agent, it must go under the same listing. I can tell you in practice, that's not necessarily the case. And that is all I will say about that. All right, months of supply. So also trend we've been seeing for a while, even though days on market are creasing up, there's still outside of the District of Columbia, there's no meaningful inventory anywhere. You have DC just a little under 4 months of inventory, Prince George's County at 232. Everywhere else is under 2 months, and Fairfax and Loudoun are under 1 month. Just keep in mind also, this is seasonal. So December always has low inventory, 1.71 months. It's actually the highest December inventory since 2018. And then for context, if you're just curious, December 2021, DMV was at 0.6 of a month of inventory, basically half a month of inventory. So December inventory is always low. Expect these numbers to increase next month. And just also keep in mind, kind of like it's like an increase of nothing is still kind of nothing. So just there'll be more inventory in January, but outside of DC and Prince George's County, probably won't be a ton in these counties we're talking about. So new listings, overall new listings were about even for the DMV, but you can see there's a lot of variance across the area. So Alexandria was up a little bit, Arlington down a little bit. Fairfax was down by 8%. Loudoun was down by 10%. Montgomery County and Prince George's County were both up by around 12%. Frederick was up big with new listings, 23% year over year. DC down big again. New listings in DC were down by almost 16%. Not as high as the 21.5% they were down in November, but still a meaningful drop in the biggest decline in the DMV. Continuing just what has been happening in DC in recent months. It's kind of like most people are just taking a break, buyers and sellers. So active listings, we already talked about, up everywhere. DC's only up a little bit though, because we saw, those new listings dropped. So it makes sense that their active inventory would be pretty steady. And these bumps, 50% of nothing is still pretty much nothing. So take these increases in active listings with a grain of salt. So showing level, the big takeaway for this for me is you see that showings are down overall. Showings are down somewhat significantly in a lot of these areas, but new pendings were almost even, and they definitely in these areas did not decline to a corresponding level. And so it's just important to note that there are fewer people seeing homes out there, but a higher percentage of them are writing offers and getting under contract. So just keep that in mind. If you have a listing, every buyer who comes in there, I would reach out to the agent, follow up with them, because the buyers who are out there tend to be a little bit more serious. Thank you, Marquita, for the appreciation. Okay, now the weekly snapshot. So normally, this is the week ending January 4th. This is the week ending January 11th. This is the week ending January 18th. Normally, I would just look at the most recent week here. We pull every week that's been reported so far, because I talked about how when the government was shutting down, usually when there's a government shutdown, you see a little bit of a depression in the real estate market leading up to that in anticipation. You see a depressed market during the government shutdown, and then you see a rebound afterwards. We had not seen that rebound. Then added to that are the expectations. Here we go. The expectations that the housing market is expected to increase with 2026. So I was really curious and a little worried. I'm like, is this not happening? Are there other factors at play? Is all the economic uncertainty going to lead to actually a stagnant or a declining real estate market? And that just doesn't appear to be the case. So median time to contract days on market each week over the previous year, going back here. Okay, so median time to contract, you can see here that this bumped up a little over the previous year, but it's been declining from week to week. So each week into January, homes are getting under contract a little more quickly than they have before. Active listings staying in that same band. You can see here the increase in active listings for each week so far in January has been in that 25 to 30% range. That's right around where we have been. Showings, going back to showings here. So you can see a massive jump in showings from week over week and then year over year of the most two recent weeks. So you've seen a big jump both in overall levels and where they were at last year in showings for the two most recent week, and then new pendings. So they were up big each week over the previous week. And so far for the month, they are up by a fair level. So taking all of the data in January, it's only through the 18th. So it's just a little over half of the month. But it looks like, and Temi, this is what you talked about, and this is where what people are seeing in the market, and this is what I'm seeing as well. We are seeing an increase in buyer demand. I think when we meet next month, we'll end up seeing, I wouldn't be surprised if when we meet next month, the January data comes in showing new pendings up by 10% year over year. That's a pretty big number. So it may not hit that, but I wouldn't be surprised. So we are seeing a definite increase in buyer demand. And this is just, I've talked about this in more detail before, but just want to note that expectations are that we will see a bump in transactions. So Bright expects the market to grow by about 8% next year. We hit 50,000 transactions this year. They're expecting around 54,000. 54,000 would still be like the lowest number of transactions since 2012, but it would be a sizable jump over this year. Okay, now key takeaways. And I've said this before, like, I don't change these up just to change them up. I could do a lot of clickbait stuff that would sound exciting, and I could post it and be like, oh my gosh, did you see this? But I think it's just more important that I give you what I think is really most relevant out of this. And so these were kind of my key takeaways last month as well, because it's a lot of similar stuff going on. I want to note that I didn't put this on here. I actually took this off of here, but more important than ever to rely on industry experts. And if you're an agent, like, just really study this stuff. Listen to me every month. Ask me questions if you're not going to study it yourself. Or if you are a consumer, just really rely on some expert advice, because the underlying economy, the underlying market, there's so much going on right now that's creating some kind of volatility. So it's really important to understand what's going on. And related to that, so key takeaway one, the market is changing, but it's not entirely clear yet exactly by how much and in which direction. I think it's going to be, we're going to continue to see an increase in listings, but we are going to see an increase in buyer demand that kind of outstrips that. So I think we're going to have a very vibrant market in 2026, but not entirely clear. And one of the reasons for that is key takeaway number two, expect major economic market volatility to continue. I mean, we're still having this lagging economic data released. If that doesn't meet expectations, you can see some really quick movements in the economic markets. And then U.S. economic and trade policy continues to be unpredictable. I mean, I try to stay away from politics here, but like with this Greenland nonsense, it's like the markets thought they kind of knew where we were going to be at with tariffs and trade policy. And then all of a sudden is, oh, we're going to hit you with 10%. We're going to hit you with 25%. Oh, we might move that up to 100% or 200%. And then it's like, what is going to happen? And then all of this gets backtracked. But like the markets still react to what they think is going on in the time. So you just a tremendous amount of volatility. Then next takeaway, DC real estate market proper is still hurting. So a lot of buyers and sellers are on pause, but because of that, that means it's a great time to be a buyer in the District of Columbia. If you're thinking about buying a home in the District of Columbia, you will have an easier time than you have had in years. If you're a seller or a listing agent, you need to know your market for all the reasons we've talked about. A lot of variance going on between different areas. What was the
You said
is
Greenland.
Iceland as far as the territory he would like to? Yeah, no, it is Greenland. He wants Greenland, and then I think the joke is that once he got Greenland, then it was going to be Canada, and then it was going to be Iceland. Okay, so if you're a seller or listing agent, just kind of know your area, because this is not a homogenous kind of thing happening in this market. There's a lot of variance both in buyer demand and inventory from area to area. Outside of DC and Prince George's County, still a great time to be a seller, a really great time to be a seller. Very, very low inventory. And if you're in DC and Prince George's County, still a good time to be a seller. You just need to make sure you price appropriately and you put your best foot forward with the home. Pretty good time to buy overall. We said lowest rates in about 3 years. Can't beat that. We'll close out. We're over time, but happy to stick on here for a few more minutes and answer questions. Christine was asking about college loans and them being in full effect, possibly taking a portion out of people's checks. Yeah, I mean, that is definitely impactful. I don't have off the top of my head, I don't know kind of what the total college debt is, what the debt load is for people, but I know it's meaningful and I know it's sizable, and that is definitely something that pulls money out of the economy, and so that can affect consumer spending, and that also can affect what people are able to cover on their mortgages. That though, well, won't go too far into that. So that's, I guess the short answer is, honestly, I don't know. All right. If you'd like to get on the distribution list for these sessions, you can go ahead and shoot me an email. Thank you all for joining us. Temi, New Year, New Temi. Appreciate you as always. Any closing thoughts or any?
Yeah, this seems to be really in the line with. Had a chance to listen to the NAR chief economics person that talked about 14%. He projects a 14% increase this year in sales, but he pivoted it by saying, like, for those who, for the, it's 14% increase, but if you don't see a 14% increase in your business, like, it's because you're not putting the effort. So he was just like, we see a 14% increase, but don't automatically assume that your business is going to have 14% increase. Make sure you're putting in the effort. But he talked about the fact that the interest rates more than unemployment had a ton to do with that, because he went back to, I think, 2006 or 2008 and talked about the unemployment market there, or was it 2012? Like, I think 2012, and the low unemployment, but like low interest rates and increase in demand. So it was just, yeah, it was interesting.
Yeah, and you said that was chief economist for NAR, right?
Yeah.
Yeah. Well, and so that makes sense because nationally in 2025, I think we saw the lowest sales level since the 90s. So our market is always a little stronger than it is nationally. And that's what I've seen also. So nationally, there's expected to be more of a rebound simply because kind of base effects again. So nationally, the market was even more depressed than we are. So if they even right the ship a little, you're going to see a higher increase. And so 14% seems pretty reasonable for me. Like I said, for our area, we're expected around 8%. And going back to employment, I've said for a while now, a mild recession in this area is probably one of the better things that could happen for the market, because it would, if the economy declines, then we should see a corresponding drop in mortgage rates, and a corresponding drop in mortgage rates will likely result in more transactions. On that, one thing I want to note, I was going to throw it in the deck and then I just forgot, but right now, I saw that the federal housing, some governmental entity reported that for the first time since the pandemic, there are more homeowners with mortgage rates above 6% than below 3%. So I thought that was pretty interesting. We've been seeing these golden handcuffs kind of with people locked into rates. Now it's like, above 6% and below 4%, that still means there's a ton of people in the 3 to 5 range. And so it's not like you just have, all of these people with 6% mortgages, but it just means there are fewer people that are constrained in their decisions by mortgage rates than there have been since the pandemic.
That's awesome. That's definitely a different conversation from last year.
All for being on here, contributing. If you're watching this later on the replay, if you have it. Yeah, there's so much going on. I feel like it's like I've been doing this now for, well, almost 4 years, 3.5 years. And like it takes me more time to prepare each month, and I feel like there's just so much going on that I need to keep up on, well, way more so than ever before. So appreciate the comments, appreciate the contribution. If you're watching this later on the replay and you have questions, throw them in the comments. I'll keep an eye on that and happy to respond to that. Thank you, Temi. Thank you all.
Bye. Be safe. There's a
I'm
storm coming this
freezing, so not
weekend.
able to end. Yeah, I would advise everyone to so I'm sure there's gonna be a run on toilet paper and water in the grocery stores because it looks like we're gonna get snowmageddon Saturday night into Sunday. Take care,
Yeah.
everyone.
Go grocery shopping now.